Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. It's Monday. Each time in the week on Monday we meet here to discuss some cycles. I'm live today, so as always, latest at the end, I will pay attention to the chat section. Please feel free to drop in your questions, as I will try to answer almost everything you feed in for today. So, let's use the next 30 minutes to discuss cycles. Even though, please don't look away. Please think for yourself what you can do to stop war on this planet. Don't close your eyes. Don't look away. Read the media and think about what can you do to make this an end. But that's just the opening, that this will not be forgotten and every one of us thinks about what to do. But the next 30 minutes, cycles. Today I have prepared a special topic because first of all, it's focusing on learning. And second, there's more into the cycles. But what could be better to discuss a real life example, what we have published here, analyzed here on the cycle scanner. Now we have the results in, the facts are in. So therefore it makes sense also to let's do a deep dive into the cycles. And I'm talking about the weekly S&P 500 cycles model we built back in October here live in this channel. So I think I already linked the video down in the description. That's the original analysis where we published 3 important weekly cycles on the S&P 500. They are still valid for today and for the future. So it's still useful to revisit them because they are still valid looking into the future. And there's a lot behind these cycles to learn from, even more than just the composite model we published at this point in time. So therefore today, for the next 20 to 30 minutes, I want to go through these 3 cycles more in depth. So let's take a closer look of what we can learn and what's important if you want to use these kind of cycles model to also build your forecast. So that's the focus for today. Next week we will update a live prediction on the S&P. So next week I will switch to live analysis again. But today let's revisit this composite model here first. Before we start, that's how the model looked like back in October last year. And please review if you want to dial in. I just recall this analysis because this is how we do our standard procedure of building cycle composite forecasting models. So if you're new to cycle analysis or new to this area of global market analysis, the first step of every workflow before you switch to charting and other projection tools, you need to detect the cycles. That's why we use the cycle scanner here at the bottom. You pick the most important cycles which stand up in the spectrum here. So the peaks which are clearly visible in this model, 381, 186 and 143. So you clearly see these 3 peaks here. You pick these cycles to build a composite model, 381, 186 and 143, and this then will plot as a composite. So we will stack up all 3 cycles on top of each other, which will build the composite, which you can see here. I'm just zooming in because that's the point of the analysis where my cursor now is, and the light blue is after the fact. So what happened afterwards, after this projection. And that's why I recall this, because this is now a live analysis we did already. So you can use this to get a real clue. This is nothing just cherry picked. This is what we did here live. And I mean, it's anyhow interesting how the composite forecast model is pulling the prices down. Yeah, you can see this on the chart. It took some time once we reached here the topping period, but now you see how really price is moved down like a magnet where price is pulling down back to the composite model. And that's the fascinating topic of cycles. And by the way, I was hammered to the wall as I showed this forecast here in December, as markets still continue to rally in the November-December period. You might remember this. So we published this forecast in October. And I was already killed in this period because it seems like this forecast is wrong off. But you see now how nicely it played out. And that's also a topic for cycles. Cycles are leading, often providing leading information where the current sentiment of the markets is the opposite often of what the cycle prediction tells you. So it's not easy to, from a sentiment perspective, to stay with this topic. But that's not the case. I just want to talk about these three cycles now, because there's more. There's more than just this composite model here. And therefore, today I want to review these three cycles in detail with you. Because for sure, you know, if you want to plot each cycle, you just select one of this cycle. No? So this is one cycle, the 381 cycle. This is the 186 cycle. And this is the 143 cycle, isolated. Each of these cycles has a different phase, different length, and a different amplitude. So I will now switch to a charting window where I've just plotted all these three cycles here at the bottom of the chart. Yeah. So, and that's also how you should organize your workflow. The first step is always you need an application which allows you to do the cycle analysis of whatever data set. In this case, we used the weekly S&P data. Then, and that's also why you need to accept the fact that a cycle analysis platform will never compensate charting platforms and trading platforms, because cycle analysis and charting are two different knowledge areas and even applications. So please don't try to ask for a cycle analysis platform, which is also a good charting and trading platform. There will not be this case. And on the other hand, you will never find a charting and software platform like a TradeStation, NinjaTrader, TradingView, MultiCharts, whatever you use, which will have perfect digital signal processing, cycle analysis capabilities. So the first step is you need to decide for the two tools you want to use. You need to select one tool for cycle detection. There are different software tools out there. We provide one with the foundation for our members, but for sure there are other ways to do this or other software tools. And second, you need to decide what's your favorite charting and trading application. And that's then your workflow. And the workflow starts with your cycle analysis. And then you move over these cycles to your whatever is your favorite charting platform. I'm just picking TradingView here because it's just easy to visualize, to showcase this idea here. So that's just the reason today I want to use TradingView, because it's free just for charting, and that's nice to demonstrate this learning or education example here today. So let's concentrate first on, I will clean up a little bit the chart here, not to clutter you too much, because the first important thing I want you to follow is the three cycles here at the bottom of this chart. Let me clean up all the text here, which we don't need right now. So it's not important. Okay, I will keep the cycles. Yeah, so that's you see two indices here. So I just using the German DAX index, but we could also use the S&P 500. It's quite similar from the main purpose here. And just for information, I've also put on top here the Facebook or Meta chart here, just to see some ideas here. And now the important topic here is that on the bottom you see all three charts plotted here. So we see the 381 week cycle. This is a weekly chart. So if you count from top to top, these counts 381 81 bars or weeks. So the green one is the longest cycle. Then we have here the blue one. This is the weekly cycle with a length of 186 bars plotted here on this chart. And we have the cycle with the 143 bars. So all three cycles, which have been used for the composite, you might remember from the October presentation. Here now, not plotted as a composite, plotted each cycle individually. So, and the cycle scanner will give you the exact information on when to align the low and the high in the past. So they are now set up correctly that the phase, so where the low should be anchored and the high should be anchored, is exact. So you can check this on the cycle scanner page if you just select one of these cycles, and then you see the low and the high alignment. And this is just using a simple sine wave plotter here on the trading view chart just to see the cycles each individually. Because what I want to first recommend every one of you to understand is that a view on individual cycles is often also giving us some insights or some facts how the market rhythm is, instead of just looking at the composite as a final result. Because you should be aware, you can always find a single cycle which might explain something. But what you're really looking for is for clusters in cycles. So when cycles align with their top or low projections. So, and what you're looking for is for important clusters when all the tops of these cycles come into an alignment in regards to the timing. So the first point in time where we see all three cycles align with their individual tops is the period here back in September to February 2000. So this is where we saw the key high in the major market. This is one of the first times where all of these cycle tops here have come into alignment. So, and then you see the phase. So the low point is quite the opposite. So you're looking for situations or points in time when all the three lows of these cycles here form a cluster. Yeah, where the second time is here, what I'm highlighting here. So here's the blue low, here's the amber low, and here's the green low. So they're forming a cluster. There's where you can expect the major market lows. And then the next important high alignment was clearly here. So this movement here from 97 up to 2007 was easy to see the alignments of tops and bottom. And now if we move further into the future from the year of 2007, you see the strong up move in the markets. And this can now better be explained if you have a look at the individual cycles and how their phases align during these periods. Because what we see here is that we don't have clear alignments of all three cycles in regards to the tops and lows of all these cycles. So that's why you don't see this theoretical move of a cycle. This is more complex movement. So therefore, let's review a little bit what happened here. So for example, here in this step here, we had the green cycle and the blue cycle in an upswing phase here in this end. But then we didn't have all three cycles in alignment. You could argue it happened here on the right-hand side. So here where the major top then in the markets is, this is where all three cycle tops have come into alignment. But before that situation, from the point of where the major low was forming, let me try to mark it a little bit on the chart, what I'm trying here. Oh, I need to clean it up. So that's the period where I wanted to explain. Here, all three cycle lows have come into alignment. The blue one, the pink one, and the green one here. So that's more or less, here's the last major situation where we had a clear alignment of a low. So then moving into the future here, there is no clear alignment until maybe this timing window here, which I'm now highlighting. So the blue one topped, the green one topped, and the pink one. So this correlates exactly to this point in time. So there you had a longer period of upswing because it took a lot more time until you see this cluster forming now. And then the next period, it also gets very interesting because there's now the diverging cycles here. So the blue one has been forming a top, while the green one has forming here a bottom in this case. So this is, you could also say from this point here, you had a clear sideways movement And then you've just seen this little cycles here around the sideways movement. So there you don't see any clear cycle, but this could be explained here. This is what I'm highlighting here. This is the blue cycle, yeah, which is seen, or the Fuchsia cycle here. You don't really know which one it is, because the green one and the blue one, they neutralize each other. And the only cycle which is there then is this kind of cycle here in the markets, yeah, which is this one here, the high, the low. Please forgive my, let's make this clearer. So let's argue here. So the green cycle and the blue cycle, at least in this period here, neutralize each other. So this one from this point in time here. So this is the period where these cycles not neutralize each other. Yeah, so that's just a flat line from these cycles here. So therefore, and in this period, you see more or less the sideways move here in the market. What is just then seen in the markets is this down, up here, which is what you see here, down, up here. Yeah, so that's just the Fuchsia or the pink cycle, which is visible because the green and the blue one have neutralized each other. So it's a sideways movement in the markets, or you just see the smaller cycle then as a result of all these cycles here. So and if you dig into these three cycles, you can clearly identify all of these individual cycles in the price movements. So that's the fascinating topic of this story here. And this gives you even more confirmation that these three cycles play an important role in past market behavior. Because this is what I wanted to try to explain. If you dig into each of these three cycles, not looking at the overall composite, you can clearly see each cycle how two cycles neutralize each other, then the only cycle which is then visible in the price. Once they align, the faces, they be a little bit extended to the right or to the left, so there's no clear symmetric cycle as a composite. This can be explained by the phase alignment here on the chart, which I explained, so that really makes sense. And then the final topic, I decided to make this public in October. I mean, I've been watching this anyhow, because in October, I think, where do we have October here? Somewhere here, you see, and the cycles showed you that the next important cluster where the next top alignment is a very small alignment of all three cycles. You can even start now to zoom into this period here to make really a close alignment, and we can start the replay modus that we just the real example. So where's the 11th October? It's somewhere here. So this was the real situation when I shared this forecast here as just a zoom into this window here as a close-up. And what you're now seeing here, what you always should try to see, the first time the first cycle topped was the smaller cycle here by mid-May. So the first top has come in mid-May from the smallest cycle. However, the blue one was still in the topping window, and the green one. And then the blue came up here in the middle, and the green one showed up here, the top in October. So this is the timing window, yeah, from here to here, where all three cycles form another very small timing cluster when they come into alignment with their topping projection. And that was the reason I always also decided to make this public, because that's the period, yeah, where to expect the key market top in the markets at this. And you see already here from the first top, at least in the German DAX, we just made a sideways movement. So the long-term uptrend already stopped here at the first point where we saw the first cycle topping here. And then you see that the other cycles just need to synchronize their phases. And if you don't have synchrony in the cycle phases, you just see maybe sideways movement. And let's now close the replay and let's move fast forward to where we are. So this is then the result here. We have seen the drop in the DAX index, and that's then the beauty, because I also wanted to show you this period here. I think that's the group. So this was the projected window, and you see now, so this is the blue one is the German DAX index. The pink one here is Facebook, where you see Facebook topped in this window, and also Nvidia at the end of this window. So almost everything in the global stock market topped in this window here. There have been some stocks and some markets which topped more early and some more lately, but almost everything topped in this period here. And you see the results from Facebook. I think Facebook dropped even 40%, Nvidia 20%, and the DAX and the S&P are similar to that, over 10 to 15% into this period. So and you really got more confirmation once you visualize these cycles individually. And now finally, because I've also told this in some of the important misconceptions about cycle analysis, one point was to improve technical analysis. And there was the question out of this group, can you share more details how you can now include this information in technical analysis? And that's the reason I also put an indicator here at the bottom of this page, because cycles give you timing information and show you points in time when is in regards to timing, not about price targets, it's about timing, when markets could turn or important turning points might occur. But you should never trade, you don't trade time, you trade price if you're in the markets here. So therefore you always need confirming indicators which take the absolute price movement into account. So that's then the purpose why you also use the charting platform and not just the cycle analysis platform. And you can improve the usage of technical indicators now by using the knowledge of the length of the dominant cycle. So in this case, it's one of my favorite indicators because it's just an optimized RSI indicator. It's free, it's open source, so there's no secret in it. It's just a little bit more smooth and dynamic here, but in the end, it's a standard RSI calculation. The key topic you will use here is that you put in the half of the dominant cycle length. So I used here the slowest one to see the fastest signals. So the smallest cycle length is about 186 bars from the weekly cycle. Always use harmonics of this cycle. So the main usage is use half of the cycle length. So you use from top to top. So half is then from top to low, which is approximately 90 weeks. It's not important if you use 91 or 89. So therefore I used just the half of the shortest cycle, which gives us a length of around 90. And that's now the calculation for the technical indicator, because the technical indicator needs to know how much history should be used for the price-based technical calculation. And that's always a mystery to most people who use technical analysis, because they have no clue how they should configure their technical indicators in regards to the length setting. What amount of history should be used to calculate my indicator? Most cases, you just use random figures or what has worked in the past, whatever. But technical indicators try to find a rhythm in oscillators. So in oscillators is nothing different than just finding rhythms in the underlying price. But the best view on these rhythms on oscillators will come to your eye if you set the correct length for these indicators where they should do their calculations, because technical indicators will often show you too much signals, which will result in whipsaw trades, or wrong signals too late or too early. And in most cases, this is due to the fact that the length setting is not according to the major rhythm of the market. So in this case, at the point in time, you know in advance what the dominant cycle length is. So you don't need only to look at the timing point at the cycle. The length information is known right in advance. So what you then look at the indicator when the classical technical indicator fires a signal based on the price readings. And this was the first time was also the case here in September. And then the second one came in mid of November. And I think mid-November, it was the real high in the main markets. So, and here are, to be honest, no whipsaw trades and even nothing in between. Until today, we are still short, or there is no buy signal up to today. So that's always why I recall this analysis, because this weekly cycle analysis is still valid up to today. It just fired 2 sell signals, one in September and one mid-November, nothing else. So nothing before. We just had the buy signal here in March, April 2020. Then this indicator just confirmed the up rally and just fired September, November, these 2 sell signals. And the first one, I would not have paid attention to the first one because it was not really in alignment when all 3 cycles have come into alignment. So the first cycle, yes, but not the longest cycle. So, and the technical indicator signal which fired here in November, this was more or less the perfect signal because that's also a match of all 3 dominant cycles. So we have confirmation of our timing window, yeah, from the cycles above. And now the price mid-November fired the final signal confirmation also from the price that this is now the market top, not from a timing perspective, from technical price analysis. And that's how you should combine these 2 informations, technical analysis, cyclic information, analyzing individual cycles out of a composite to get a clue if a composite model is valid or not. Also analyze the individual swings of the underlying cycles of your composite model. Pay attention to the situations when all cycles of your composite model come into alignment in regards to their phase. So don't just blindly follow on swings of the composite. Search for the swings on the composite which are based while all cycles of your composite model are in phase alignment, so even a top or a low. These are the points in time you want to look. Sometimes they are covered just by the composite model. You don't know if this turn is caused by 1 cycle turn or by all 3 cycle turns. So that therefore it makes sense also to analyze the individual cycles. And if you find confirmation, yeah, when these 3 cycles mix up between price and the cyclic behavior, you even have more information to trust this projection. And then convert this information on the technical analysis. And I mean, in simple terms, just wait for these situations to happen. Composite signal in place, all 3 individual cycles confirmed. They form a very small timing cluster, which are the important situations, and confirmation by technical indicators. You don't need more to be honest. And the only thing you need to do is you need to be patient. And what I see the most mistake is most which are trading, they just want to trade because of trading. And then you will fail and you will lose money, because if you just trade because you want to trade, and then you force yourself to see a cycle turning. So you search at least until you find something which you think you could trade just because you want to trade. And that's the complete wrong approach. Cycle analysis, you will need to spend a lot of time in the cycle research, cycle application, search for the clusters to form timing clusters. The beauty is you will see them in advance, so you have enough time to prepare until the point in time arrives. Switch to the technical platform and then be patient. Don't overtrade anything. Wait for these alignments to happen. If they don't happen, don't trade, or at least not based on this information here. So that's also a clue. Don't try to force yourself to see a cycle just because you want to trade something. That's not how you should do it. But let's more stick to cycle analysis and not to trade or risk management education. Yeah, that's it for today. I think maybe you've learned something from how to analyze charts also from this example here, because these 3 weekly cycles are still in place. They have just started to unfold their force now. What's often important when you see these cycle clusters, they often need an external trigger to unfold their force. If you might remember my forecast from these, there have been 2 projections I outlined in October, because one could be we could see sideways market from October last year, and this cycle downswing goes into the year of 2023, because we have been in a very positive mood and a very positive sentiment environment where the cycles turned. So if the sentiment would not have changed, and if the overall sentiment would have stayed positive, I would have expected sideways market for the next 1 to 3 years, because and that's also if a cycle downturn stops an uptrend and results in a sideways move, that's also a valid result out of cycles in a positive environment. But if you then have external triggers in the direction of the cycles prediction, which we had then in the year of 2020 due to the COVID crisis, and in the beginning of this year due to the war in Europe now initiated from Russia, these are the external triggers which then even amplify the direction. So the direction anyhow is decided mainly by the cycles. It's then just if you see changes in the mood and the underlying sentiment, a negative cycle could have resulted best case in a sideways overall global market, worst case or real case in a sharp downtrend if the external triggers come in. Oh, excuse someone calling. But anyhow, that's it for today. Please review these 3 weekly cycles. Next week, we will get to the daily time frame, and we will update, is there a chance for a rebound? Yes or no? It's not about the weekly cycles. It will be then we will drill down into the daily cycles, because there are some interesting readings today, not on the global market, but from individual sectors. We can see that there might be the time for some rebounds, at least from the cyclic perspective, which will not change the overall picture, which is still there until 2023. But there will always not be a straight line. So as also the uptrend had corrections, so now we are on a downtrend and we will see upswing corrections. So let's use cycles to find the moments in time to time that. That's for today. I will now pay attention to your questions in the chat sections. Let me try to review. Lars, can you please explain which indicator to activate on TradingView to show a cycle on the screen? I mean, I'm not here to give recommendation on trade software or charting software, but at least as it is a very simple answer, I can just show you that. It's not an indicator, it's a drawing tool in TradingView. So if you use the drawing tools, here you can see it in the left lower corner. It's the drawing tools. You can draw a simple sine wave on the chart. And that's what I'm doing here. So it's not an indicator. It's just a drawing, and you then need to align the length manually and the phase manually. And that's what I said initially. You need to have another tool to know where to align the phases and where to align the length setting. So this is where all charting platforms fail, because they don't give you information for that. So that you can pull over from the cycle analysis platform. Okay, so Epis, I hope this helps you how this was done. Murat, is this all based on Hurst cycles? No, these cycles I've showed you here are just purely detected by digital signal processing on the weekly S&P. So the lengths, or these 3 cycle lengths, have been detected by a special kind of Fourier transformation. So it's called dynamic cycles, which are clearly seen by this kind of analysis in the markets. They are not based on the fixed model which Hurst was using. So Hurst has a nominal cycle model or a nominal model based on fixed cycle lengths, or at least nominal cycle lengths definitions, which you could also use, but the 3 cycles used here are not based on the Hurst cycles. Murat, thanks. I see you already gave the answer to to Epis. Thank you for that. Lars, why is cycles not as accurate with individual stocks? Alan. Yeah, let me try to find the good answer, at least in short terms. If you want to use cycles on kind of data sets, you should use data sets which where you have a low amount of noise and individual fluctuations. And in individual stocks, the price could be news driven, what I would call its noise from a point of digital signal analysis. Individual sharp movements, like you might be able to explain due to media news, are just one-time or random movements, not cycle-based. And even individual stocks might be influenced by some individual forces that they are pushed in a special direction by a special group of traders, which is not then influenced by cycles, which is influenced by special groups. It's influenced by random news. So therefore, individual stocks often don't follow cycle projections, or the noise to signal ratio. If talking in technical terms, you want to have data sets with a low noise to signal ratio. So where the signal is very high in the data set and you have a very low amount of noise. And in individual stocks, you often have a very high noise range. So a lot of fluctuations, price movements driven by individual activities. The noise is then too high to detect the real cycles which are there. So therefore, I often recommend to use cycles on a data set which accumulates a lot of individual stocks. Therefore, the indices are very, very good to use for this, because individual random moves by individual stocks will be compensated and will be wrapped into the overall index. And you should use sentiment-like measures. So where it's not driven by an individual jump. So where you see sentiment measures, like for sure on the cryptocurrency, there's a lot of it's not an individual movement, it's also a sentiment-based movement. So Alan, I hope this explains a little bit why in stocks it's often not as accurate as if you use overlying data sets. Eric, my question is why you use the daily cycle analysis in most of your weekly presentations. So the weekly presentation, you talk about the Monday show. And because the weekly cycles model will not change very often. So it would be very boring if I repeat the weekly cycles model every week. That's also here. I mean, this weekly model was built in October last year, and it's still valid up to today. So, and I think that's also if you have longer time frames, like the weekly time frames. These are important time frames and cycle models once you've found a valid model. And then you don't need to change this week by week. Yeah, you can just recheck it week by week. So, but it then makes more sense how daily cycle analysis fits into your weekly model. I've not talked about this today, but I think at November or the December, if you followed my weekly sessions, there was also a sessions when I said, and we analyzed the daily S&P 500 cycle, and the daily S&P 500 cycle, by the way, was not in alignment with the top until December. So you had the next phase alignment, and you know the market rallied until November, December period. And you could see this, the daily cycle was still pointing up until December. And I think in December, January, I pushed an update where I said now the daily cycle on the S&P is now in alignment with the weekly cycle. So back to your question, Eric, it's important to more regularly update the daily cycles model, because the daily cycles model might change more regularly, while the weekly or a weekly model is more static and more fixed and won't change so much. That's the reason in most cases I concentrate here on the daily cycles week by week. Okay. Samuel, your question, can cycle analysis be used for price cycle analysis projections as well as Peter Eliades does? That's a good point, because we are focusing here on time-based cycle analysis and projections, but you can use similar techniques to do price projections. And that's based then on the Hurst model. So Hurst introduced a concept on, I think it was called the demarcation line. So it's published by Hurst already in his early days. And the key is, so you use the same cycle as I showed you from the timing. If price has confirmed, for example, a bottom, and then has moved up of a quarter of the cycle length. So you need the full length is from top to top. Half of the length is from top to low or low to top. And then if you use a quarter, it's then half of one swing. And if you have passed half of one swing, you know what's the price movement of one half of the cycle, so the full upswing. And then you can just add this on top of the cycle, and then you could expect, okay, this will be the next price movement until this cycle is completed. So what Peter Eliades is doing, following by the Hurst model, but you can only see this after half of the turn has been passed. So the time bias projections give you the turn before the turn even happened, while the price projection model from Peter Eliades, or the Hurst model, just waits for half of the cycle to be confirmed. So it's a more safe model to say, okay, once price has turned and confirmed the cycle, then you just wait for once half of the time of the cycle has been passed, and then it triggers a signal on this concept, because once half of the length is passed, you would expect the other half of the cycle, and then you can build your price projection. I hope I tried to explain it in easy terms. So yes, you can combine these models and the logic. It's just you need to convert, or you can measure the amount of price movement which has been achieved from a quarter of a cycle or half of the cycle, and then you can expect also the same amount for the next half. You just enter these trades once half of the cyclic movement has been passed, and then you could expect, okay, the next 20 days it will continue to up move, and as the other 20 days, the amount of price movement here. So that's the concept. It's a little bit more complex, but Hurst introduced this concept here. Okay, that's for you, Sammy. Samuel. So now that's not now Sammy. Hi Lars, can you explain where you set up the starting point of calculation for cycles? This is still a mystery for me. And then I have different setup that is confusing me, that I don't know what is the real one. So yes, I try to find a simple answer, but the question is related to where to align the starting point of the cycle analysis on your chart. So, and the starting point, oh, sorry, I think the window is a little bit broken here, is where is the starting point of the analysis? So in this case, that's the point I have selected here in the year of 1997. And the outcome of the result here for sure depends also where this starts. So the in-sample period you put into the scanner model for your detection. In general terms, the starting points should be multiplied by 3 to 4 by the longest cycle you want to be able to detect. So for example, if the longest cycle you want to detect is 300 bars, so if it's a weekly cycle, we talk about 300 weeks as the longest cycle you want to detect. If we talk about daily cycles, and 300 days is the longest cycle you want to detect, you should multiply it by 3 to 4. So 300 multiplied by 3, we get to 900 bars. So if you use weekly, then you should have 900 weeks, or if you use daily, you should have 900 days. So that's where you should put the anchor or the starting point of your analysis. You should go back in history around 900 bars in the past, because that's the best amount of data to use for the current cycle data. You could throw in all history you want to have, and that's also a fault most cycle analysis do. Yet they think I need 200 years of historical data. This will reveal the best cycle model for me. That's wrong in regards to the projection area. That's right in just the historical analysis, but you won't find the ideal cycle for your projection, because you don't need the current, or you need, or to say it this way, you should have 3 repetitions of a cycle in your data set. So if we have 900 bars, you can see 3 repetitions of a 300 bar or length cycle. That's enough to detect the cycle and to trust the cycle, because the cycle will anyhow, due to the principle of variation, vary between 290, 310. So it will never be a static cycle over a long historical data set. So it's enough. If you have the last 3 repetitions in your model, it's enough to build projections on, because you're not interested in the overall history, how the cycle projected. But I try to keep the answer short, Sammy. So the starting point of your analysis should be the longest cycle you want to detect multiplied by 3 to 4, and then go into the past of your data set and set the anchor there. If you want to fine tune it at this point in time, try to find the current or the major low or high which occurred 900 bars ago, because that's then even fine-tuning it. So maybe you use 931 days because there was a major low or high in the market, or 876 bars of history because there a major low in the market occurs. So that's then the fine-tuning, but that's the standard way and the best way to get started. By the way, you're close to Hamburg. Greetings. Moin moin. Nice to meet you here. Okay. Kenjay, what is the recommended data range for regular analysis? Results tend to vary widely depending on the chosen data range. Yes, but I think that's the same answer I tried to give to Semi, how to set up the settings, Kenjay. So that I tried to explain exactly how to set the range. And Sammy, I hope this also answered your question into find the right starting point for the analysis. Okay. With black background, it is more difficult to see red and blue lines. Come back with the white background. Yeah, I agreed. Or I excuse for the black background. I can also... maybe not here, but there's a place. Here we have the white background. I mean, I can't repeat the full show, but there's also a white background possibility. And I agree the different colorings of these cycles, but you can at least make a screenshot here for your own analysis. So at least you can zoom in. I will just clean up here the chart here, make it even larger so that you can review the explanation I did. I will make this chart even larger here. We don't need that. Let's get to an end here. We don't need this analysis. So that's the cleaned up chart now. I think you can do a screenshot and you can analyze the cycles and the alignments I just tried to explain in the video here. So you have this also with white background. Okay. Murat, Gunn was a famous trader who traded using planetary cycles. Do you think they are important too? Yes, for sure. Planetary cycles are important, and often important weekly cycles and daily cycles can be explained due to planetary movements. But that's another area, or that's also another door of knowledge area which we would open. And therefore, this cycle analysis session should stick to pure cycle analysis. The planetary movement, and I think that's the next step also in the knowledge area, to analyze planetary cycles in conjunction with the outcome of digital signal processing. And yes, planetary cycles play an important role, not just of planet, but also the mixture of how the planetary cycles interact, which is other in our planetary system. And we even have different forces then which also approach us here on Earth, like geomagnetic forces, like solar forces, like sun cycles. So there's a lot more out there also with planetary cycles, but it would extend the focus of these weekly sessions here. It's a special area where also some of my board colleagues at the foundation have deep knowledge. But it's a very small group if you talk about planetary cycles. And you need to take care that you not get too much into the esoteric area if you talk about planetary cycles. But maybe from time to time, it's a good idea to bring in some relations to planetary cycles. There, I agree. Alex came in late. Did you use the composite cycle analysis feature? Yeah, sure, I did. So you need to rewind and get from the start. Tell us about your book, Lars. I mean, I've written 2 books on cycle analysis. I don't want to promote those books here. But if you, and there's also a second part of my books. If I don't know, Kenjay, if you relate to that. But the second book is related to metonic cycles. So if you're interested in the area of planetary cycles, and there's maybe at the ending now for this session, and that's a follow-up for each of you. What is the metonic cycle? So that's the entry question for our session next week. If you can't answer this question, what the metonic cycle is, you will not be allowed to come into the next Monday show, just for fun. So if you know the metonic cycle, this is based on planetary movements. And if you look up into the sky, when you will see the exact same alignment of the stars and the planets, that's the metonic cycle. So it plays an important role. And yeah, you can play cool stuff of that. And if you're interested in learning more on dynamic cycles and metonic cycles, you will find my books out there anyhow. So, but thanks for asking, Kenjay. That's it. We have spent almost an hour today. Thanks for your question. I really like the interaction with you here in this group. This makes it more engaging for me. Anyhow, as you know, these times sitting for a camera and speaking into the monitor might get boring if I don't get feedback. So thank you for joining the session today. I hope you will also join next week and the weeks ahead. I try to be, in most cases, live. There might be some exceptions when times forbid that. But please like, please subscribe, please join next week. Have a safe week, stay safe, and see you next week. Bye.